So the charts let us visually quantify that price action. The charts are a navigation tool, very similar to a roadmap, but as I've said before, they can also act like a Doppler radar in forecasting, almost in a predictive manner, of what will be coming up, what price action is impending. Candlesticks are a type of chart where each series is defined by the time increment. So when we talk about the sequence of numbers, okay, the series of numbers, now the actual numbers within that series breaks down to the period, and the period breaks down to the time frame of the chart. So for example, a 1 minute chart, okay, is going to basically be a 1 minute candle that at the beginning of that minute, there's your opening price. And then you get all the trades in between, and then by 59 seconds, by 60 seconds, the candle closes. That's the closing price, and then you have your high and your low in between that. On a 5 minute chart, each series is based on 5 minutes of price data. 15 minute chart, it's the same thing. And those series make up one candle. And it's the succession of the candles that paint the larger picture. So by utilizing that price action with the candlesticks alone on the charts, that gives us a very well, you know, gives us a clearer indication of the price action. But we still need more. And allow me to introduce you to the stochastic oscillator. The stochastic is a momentum indicator. The stochastic fast plots the location of the current price in relation to the range of a certain number of prior bars. Stochastics are used to measure overbought, oversold conditions on a scale of 0 to 100. Above the 80 band is considered overbought, and under the 20 band is considered oversold. Okay, now that is the conventional definition of stochastics. And so with the 80 and 20 bands, the conventional thinking is that when the oscillators move above the 80 band and then fall back under the 80 band, that's when you want to sell your stock or short the stock. When they fall back under the 20 band, then it's oversold. So then when the oscillators cross back up above the 20 band, that's your classic buy signal. And as with anything that's generic and conventional, people have found that the stochastic oscillator is not very consistent. There's a lot of criticism about that oscillator, which is great. That is a great thing, okay? Because I don't want everybody to know how to use the stochastic oscillator correctly. But that is a conventional definition. And by just going with a conventional definition, you will find that it works sometimes, but sometimes it doesn't work. Sometimes it works beautifully, sometimes it works horribly. So there's not much consistency with a stochastic oscillator alone. As with any particular indicator, one indicator alone is not going to be enough. Now with the stochastic, you know, almost every platform has some different tweak on how they set up their stochastic. It says stochastic oscillator, okay, meaning one oscillator, but it's always going to be two lines. It's always going to be two oscillators. And you're working with the percentage D, which is the lead oscillator, and the percentage D slow, which is a moving average of the percentage D. Does this sound or look familiar? Yeah. The moving averages that we use, you have a lead moving average and a laggard moving average. It's pretty much the same thing with the oscillators. You have a lead oscillator, and then you have a laggard oscillator. And then so therefore the crossovers at certain points, okay, are inflection points that are going to get some type of a reaction. And that's all you need to know. That's all you need to know in regards to the classic conventional shallow surface generic definition. So the 80-20 bands. Now, anytime the stochastics get near that 80 band, you're going to have some type of a reaction. Either it's going to reject it, or it's going to stall and then break through it. Anytime you get near the 20 band, it's going to either reject it, deflect and bounce, or it's going to stall and collapse. Okay, so the 80 and 20 bands are really what you want to keep an eye on. Now, once again, you don't want to go by the literal conventional definition or notion of how to use the stochastics by strictly going long off 20 band crosses up and short off 80 band crosses down. Okay, sometimes they work really good and sometimes it's just chop. And when I discovered stochastics on a 1 minute time frame, okay, it took me a while to figure out the inconsistency. Now this was back, during the internet mania. So I started off with just the stochastics and the level 2. And they had axe market makers back then. And time of sales, and it was a wonderful time. It was an amazing time. So the stochastic, even though it had its faults, okay, was when you got the 20 band bounce, you got a real bounce, all right? Because they had fractions back then, and stocks moved in big increments, and so it was very effective back then. However, there were still moments of inconsistency. For example, I would play applied materials, and that was trading. Wow, that was probably trading around between $50 and $100, right? So when you get a 20 band oscillation up, okay, sometimes it would be good for a point and a half scalp. And sometimes it would be only good for maybe a half point or 3/4 of a point briefly, and then it would collapse 2 points. So when you have inconsistencies, those inconsistencies can be costly. And because the stochastics work so good on these low band bounces, didn't pay too much attention to the inconsistencies initially, but gradually it got to a point where I questioned if stochastic was helping me or hurting me, until I was introduced to the moving averages, and that was another piece of the puzzle here. When you add the moving averages, now I have a roadmap. Stochastic is the engine, but the moving averages is the roadmap, because the moving averages will show me visually, hey, higher highs, higher lows, higher highs, higher lows. That's an uptrend. And the moving averages will visually show you that uptrend. It will also show you the trend channel. It will also show you the support levels on the pullbacks, and then the trend reversals. And that's what got me thinking. That's when the light bulb turned on. And I realized, I measured that a 1 minute stochastic full oscillation going into a moving average downtrend would reap me a very small bounce and then a collapse. Whereas a 1 minute 20 band oscillation up on an uptrend would reap me 1.5 to 2.5 points to the upside on a full oscillation. Do you see? So either I'm going with the wind on my back, okay, or I'm going against the wind, with the trend or against the trend. And that was the beauty of the moving averages. So real quick, let's define what the moving averages are. Moving average is a set of numbers, each of which is the average of the corresponding subset of a larger set of datum points. By plotting a line to connect these numbers, a moving average is developed by using different fixed subset sizes. 5 period, okay, which means a 5 period just simply means five number series, okay, and each number series is the increment is whatever the chart increments are. So if it's a 5-minute chart, then a 5 period moving average is going to be the average of 5 minute candles. So basically 25 minutes. And then same thing with a 15 period moving average. And the moving average creates a visual of the price data that can show you the direction of the trend channel, which is the differential between the 5 and the 15 period moving average, the space in between there, and then support and resistance price levels. Moving averages are used to smooth out short-term price fluctuations and highlight longer-term trends. Simple moving averages is the unweighted mean of the previous data points. And the simple moving averages is pretty much what I use anyway, guys. Some people like to use exponential moving averages, and I actually do use exponential moving averages. Actually, no, I don't think I do. No, never mind. But exponential moving averages are weighted to give more significance to the latest series of data, generating a quicker reaction to recent price changes, so they say. Exponential moving averages are used in the MACD oscillator, the moving average convergence divergence oscillator. For me, I prefer the stochastic oscillator. Some people prefer the MACD. To each their own. You might prefer the MACD, so you might want to try that out. And what you can do is use the stochastics with the moving averages, as I'm showing you, and use that as a benchmark. You see? Don't you like that word? A benchmark. Just use it as something to match up and compare against. Okay? Or to see how well they correlate, and if you like them both, you can use them both. With the moving averages, I use a 5, 15 period simple moving average, and then 50 and 200 period moving averages. The 50 and the 200 period moving averages, you hear about that a lot. You hear about the when the Dow drops, or the S&P 500 or the S&P 500 index drops, and it gets near a 50 period moving average. You hear the media saying, "Oh, the S&P 500 is nearing its 50 period moving average," or the Dow Jones is nearing its 200 period moving its 200-day moving average is what they call it, right? So everybody is familiar with that. In fact, what do they call it? The death cross is when you get the 50 period moving average to cross over down through the 200 period moving average. That's called the death cross. That is, whoa, that's the beginning of the bear market. Okay, but everyone is familiar with these moving averages because it's out there. The public's aware of it. And when you get everybody keeping an eye on these large moving averages, then it matters. Okay, then it becomes significant. If everybody's watching it doesn't mean everybody's right. Okay, but the mere fact that they are watching it is an opportunity either to jump on the bandwagon with them or to play against them, because it's a minus-sum game. So this is your moving average crossover, which simply means you get your lead moving average 5 period to cross over the 15 period on the way down, or cross over on the way up, and that indicates a trend reversal, a trend change. This is what you call an uptrend, and there's your downtrend. Okay, and it's very simple. And for now, this is just pretty much an introduction. So I'm going to go over it, in the simplest of terms. As we move on with the levels and we get more refined, you're going to be able to shred this simple definition apart, okay, and find the real inflection points. Using our tools, you are going to be able to basically go through and just pretty much evaluate everything that's going on, and with the addition of the rest of the charts and the tools, you will be able to find an area that will possibly forecast or foreshadow an impending price move. Because this game is all about what, guys? Finding transparency before it becomes too transparent. So having a forecasting or foreshadowing, almost predictive type strategy, okay, is what is going to give you the edge. So anyway, my whole point here is, let's just pacify the traditional, conventional notion of what these indicators are for now. All right, so as I said, you combine a stochastic with the moving averages, and now it starts to make more sense. Like, for example, look at this moving average crossover through the 20 band that makes a full oscillation up through the 80 band. See that? So what does that entail? On that crossover, EXPE, this is a 5-minute chart. On that full oscillation up, you get an uptrend that forms on the 4790, 4790, where the stochastic crossover crosses up right around, well, let's just say 4780, 4790. And during that full oscillation up, you see how the stock rises all the way up to 4850. Okay, and the moving average stochastics peak out a little bit, but notice something. Remember what I said about the 80 and the 20 bands. At the 80 band and the 20 band, you're going to get a reaction. Either they're going to try to deflect it and bounce it back up, or they're going to stall it and then collapse it back down. Well, in this instance, they popped it up to 4850. They tried to take it back down. They couldn't hold it, and they deflected it back up. And it spikes back up to about 4870 before the crossover crosses it back down. And then you have your full oscillation back to the downside. All the way back down, almost a full point to the downside. Okay. So then when you get a low band oscillation attempt down here, oh, here's a 20 band. Hey, let's we get a cross. Here's a 20 band. Hey, let's go long. What happens? It upticks maybe 10 to 15 cents, and then it collapses 60 cents, 60, 70, actually, yeah, 60, 70 cents. Just collapses. So this was the problem that I was seeing. Why? How come you get a crossover, low band, 20 band cross up attempt, and this thing doesn't move? And then when it crosses back down, oh Lord, that's painful. And so when I was introduced to the moving averages, wow, now that makes sense. Look at that. Just don't fight the trend, right? Go long when your trend is up. Go short when your trend is down. And don't try to fight the trend. And that was one of the first rules, okay, that I came up with the stochastics and the moving averages in developing the strategy. Now, Bollinger Bands are a price range indicator that measures the highness or the lowness of the price relative to previous trades. And as I showed earlier with the star and hammer formation previously, that's usually where you're going to get your nominal upside price and your nominal downside price. So they do a good job of capturing the range, which also gives you an idea of potential profit targets or stop loss areas. Okay, so now when you introduce Bollinger Bands into the equation, now you have a visual of how far up the stock can move, okay, before it hits the top of the range and then will pull back down, and vice versa. How far will the stock fall before it coils back up? The data input takes into account the number of periods and standard deviation. We use 20 period and 2 standard deviations. Now, the other advantage of Bollinger Bands is you notice how they will compress, which means your upper and your lower Bollinger Band will get, the range will get tighter whenever you get a compression. Okay, knowing that Bollinger Bands will compress and expand, okay, or contract and expand, contract and expand, contract and expand. When you know that an expansion is coming, which means you have the tightness, it's range bound, and then expect some type of a breakout or a breakdown. So Bollinger Band contraction and expansion. Now let me also add the middle Bollinger Band is a 20 period moving average, and it's very significant, especially on that 1 minute chart, which I have went over in the prior videos. On the 1 minute chart, I like to pretty much just keep a 5 period moving average in the yellow, keep that 20 period moving average, which is part of the Bollinger Bands, and a 200 period moving average. But understand, Bollinger Bands, when they start to contract, it actually is like a yellow light telling you ease up on the trading, because all you're going to do is get chopped. You're just going to get chopped and chopped and chopped. Wait for a break and the Bollinger Bands to expand before stepping into a trade. Now take a look at the stochastics here. Look at that. Just a big jumbled mess. Okay, when you have a contracting Bollinger Bands and your moving averages are basically in a tight range and your stochastics are chopping like this, okay, this is when stochastics are not very useful. Why? Because there's no trend. There's no active trend. Okay, there's no follow through, and that was one of the problems I started to come up with the stochastic moving average charts. Well, how come there are periods where the stochastics are going to do this and the moving averages do this? So when I get an oscillation attempt or an oscillation, I really don't get anywhere. And that's when I discovered the Bollinger Bands. You add those onto the charts, and then it visually tells you, hey dum-dum, this range is very tight. It's in a contraction. Okay, it's compressing. Don't work yourself up getting chopped up and down, up and down, up and down here, because then you're going to miss this move here. Even worse, you get chopped up and down, up and down, up and down. You finally decide, screw it, I'm just going to go long. I'm going to hold on to it. And then what happens? You get caught on the wrong side of the trade and you get punished. So contracting Bollinger Bands means hit the brakes, slow down, wait for the expansion to take over. And then once the expansion takes over, that's when it's time to look to get back into a trade. And you'll also notice down here on the volume bars, during that contraction period, you're going to have very low volume bars. You're going to have the lightest volume bars. Why? Because there's no participants. The active participants are sitting out because they realize, hey, this is worthless, this is futile. And this is the problem with a lot of traders. They don't understand that there's a contraction here, that the volume is low, and it's a dry period. Yeah, dry climate period. So then what happens? They become the target. They become meat. They become fodder. They become food for the apex predators, who are the HFT and algo programs, just chopping you in and out, in and out, in and out. This is what you want to avoid. Just avoiding this, okay, that's half the battle. It's a lot easier, guys, to maintain a strong mental outlook, from a position of strength, from green on your P&L, rather than starting off with red and then having to dig your way out. If you can avoid the red, the green takes care of itself. as long as you have a plan, a strategy, a system that works, okay, and you follow that system. But there are periods like this that are fuzzy, and this is what traps traders. This is what chops traders. By removing this, cut, and don't paste it. Just cut it right out. Okay, you're going to make a world of difference with your trading. And this is a dry climate type action. Very tight action, tight Bollinger Bands, low volume, no liquidity, no trend, just pure chop. To suck you in on the wrong side, trap you, and then torture you. Avoid this, and you're going to be much. So this all boils down to, how do the markets move? Okay, not why do the markets move. See, when we ask that question, when we pose the question, why do the markets move? Now you're falling victim to the conventional thinking. When you watch the financial news networks, what's their job? Their job is to always pacify the public and to always accept credit for figuring out why the market moved that particular day. To simplify and rationalize the market movement. Whether it is responsible or it isn't doesn't really matter. Okay? Especially as traders, you don't care about the reasons why. You care about the reactions. So why is not the issue? Why always exposes itself after the fact? The transparency comes out. Oh, hey, that's why it moved. That's not going to help us. The real question, the lateral thinking, is how do the markets move? And the markets move for various reasons. Okay, I know that's a pretty generic answer, but let's even go beyond the various reasons part. Let's talk about just the mechanics, the general order of market movement. So based on what I've just gone over, there's three main categories of instruments: futures, stocks, and options. And the general order of market movement is futures go up, stocks are going to follow, stocks, ETF prices are going to follow, and that's going to pull up the options prices. Nice and simple, right? Futures up, stocks move up, options move up, futures move down, stocks move down, options move down. It's so simple. It's a general correlation between all the classes summed up into three types of components: futures, stocks, and options. Futures go up, stocks move up, options move up. Okay. That's the basic movement. So then I ask you, why does this happen? Futures move up, stocks move down, and then options move sideways. You ever notice that? It's been happening a lot more lately. And when I say lately, in the past few years, okay. And I know that's, for a day trader, years is, in a couple hours is like a year. Okay, so, but step back and look at it from a bird's eye view. Futures move up, but stocks move down and options move sideways. Why is this happening? And based on the traditional model of the general market movement, futures up, stocks move up, futures move down, stocks move down, options move down, okay, that symbiotic relationship made sense. That symbiotic relationship is how a lot of traders made really good money. That symbiotic relationship was the basis of liquidity trading, of rebate trading, of playing volume, heavy volume playing market maker. Okay, being able to be your own market maker, work leverage, work the spreads. But then something happened, and it resulted in this. We got some type of a mutation that's happened in the markets. And because of this mutation, market makers have gotten blown out. Prop traders have gotten blown out. Retail traders have walked, okay? Because this doesn't make sense. What is the element, the phantom menace that has creeped into the markets and like a virus has changed, literally changed the DNA of the structure of the markets? Ponder that thought, because that's what we're going to talk about in the next video. Talk to you soon.